Our Wall Street Week daily segment, the host of Wall Street Week, David Weston, joining us as he does every day at this time. A lot of great interviews that we always have on this segment and on your weekly show. You actually spoke with one of the more well-known bankers out there.
Exactly. We're building up those bank earnings starting on Friday. So we turned to Bob Diamond, who used to run Barclays. Now he's the head of Atlas Merchant Capital. And we talked to him about the state of the economy and specifically what he expects from the bank earnings coming out soon.
I think inflation has peaked. It's working its way down. As we have also talked about, the Fed waited way too long. But given that it was just a year ago that they began the rate increases, I think the impact on slowing inflation and slowing the economy is taking its impact. But on the other hand, will this be a deep, dark slowdown? Not in our opinion. I think the stimulus that came in during COVID has meant that we've had very, very robust balance sheets, both kind of corporate and institutional as well as personal. I think the labor market has stayed strong. I do think there's been a bit of weakness in wages just recently, which I think the Fed would be pleased with. So our sense is there's a real slowdown happening. Our sense is that the economy this year will continue to be very choppy, and we'll see various accidents happen because of poor balance sheets driven during the long period of monetary easing. But that this will be a longer correction, but a milder correction than I think we were anticipating a year ago.
What the Fed has done so far has, some would say, broken a few things, like Silicon Valley Bank. We see bank runs now once again. You said there may be some more of that. Where would you look for it? We're about to see bank earnings come out later this week and next week. What do you expect?
Well, if I can go back to your question a little bit, I think what the Fed got wrong wasn't the rate increases. What the Fed got wrong was waiting too long and putting in both too much stimulus and waiting too long before they cut the stimulus. I would expect to see distressed corporates, even though we expect the economic correction to be longer and mild rather than deep and dark. I think we're going to see quite a long period of distressed corporate opportunities.
One of the things we've seen certainly is deposits coming out of some banks, particularly some regional banks, I would say surprisingly quickly. I wonder if you were surprised at how quickly they came out. And where are we now? Because every week we see deposits going down.
When SVB got into trouble, there was about 18 trillion in deposits at banking institutions in the U.S. Today, it's just over 17 trillion, so it's down close to 5%, the absolute. Now, part of that is with money market rates higher. The difference between a money market rate and a deposit rate can be 2 or 3%. When everything's at zero, there's no difference between a deposit rate and a money market rate. So I think there was a lot of money that moved into deposits out of money market funds and out of treasuries, the lower rates were. I think today, as rates have increased, you're seeing more and more money come out of deposits into more competitive returns of money market funds and U.S. treasuries and investment grade corporate.
So you run some pretty big banks. What do you do if you're running a bank and you're seeing that phenomenon? How can you compete with higher rates, for example, at money markets?
Well, I think the deposits are a very, very core piece of the bank, and I think more and more banks will be competitive. But the other half of that is, I think more and more banks are going to be thoughtful about what percentage of their deposits are guaranteed. And that has a double-edged sword. Should we be increasing the level of insurance? And I think absolutely we should, certainly over $1 million. If you'll recall, in 2008, during the financial crisis, the FDIC increased that level from 100,000 to 250. I think today it has to be multiple millions because so many small businesses are counting on their deposits to meet payroll or to meet inventory financing or various and sundry other things. And you don't want that small business moving their money between banks on a regular basis.
Does that have a material effect on the income statement of the banks? Because as I understand, there'll be some assessments from the FDIC. If they went to $1 million guarantee insurance for deposits, there would be some assessments on banks. Does that affect their profitability?
Well, I think in my mind, the beauty of FDIC is it's funded by the banks. So it's funded as a charge on the deposits. And I think every bank would be very, very clear that those deposits, by and large, are a profitable exercise. So some percentage of that going into a fund to guarantee the deposits in case of a crisis like SVB is appropriate. And it keeps it away from kind of taxpayer funding or a bailout. The quid pro quo for that is that the equity holders the unsecured debtors, and the management team and the board are all at risk for bank failure. And I think that system can work quite well.
You say the deposits are profitable, but at the same time you say the banks are going to have to get more competitive on deposits. That means, I assume, they're going to have to raise the interest rates they're paying in the deposits. It'll make it less profitable, won't it?
Yeah, but see, this goes right back to the other point I was making in the op-ed I wrote recently in the Washington Post. We have 4,500 banks in this country. No other country has a banking system like the U.S. The positive impact that has by providing a better cost structure to lending to farmers, to small communities, to regions. As the big banks just have such higher levels of capital today and such a higher cost structure, the competitive nature of that 4,500 banks is very, very positive in terms of reducing the overall cost to the consumer. I think that's the more important part of it. To the extent that you see deposits move just into the larger banks and we get more and more concentration, there's not only more risk in the system, but more importantly, there's less competition and less service for small businesses and communities.
In terms of the big banks, we're really getting earnings toward the end of this week and then into next week. What are you expecting? To what extent will what we saw with Silicon Valley Bank and the aftermath really be affecting, maybe even not necessarily their earnings right now, but their projections for what they're going to be making in the out quarters and years?
Yeah, my sense is they'll still struggle a bit on kind of advisory revenue because the deal-making environment is still slow, so that portion of investment banking will be down. But I think we're going to get a positive surprise by the amount of business that's moved from small banks to the larger banks, not just deposits, but people opening up more and more accounts. And I think we'll get a pleasant surprise by the trading revenues. Whenever you see this much volatility in the securities markets and this kind of movement in U.S. Treasury yields and rates, the banks should do very, very well. So my sense is we'll see a positive surprise.